Good morning. International taxation. In order to enable various countries to enter into treaties, there are standardized of some extent organization and economic cooperations and development. OECD and United Nations developed certain model tax treaties. These treaties are used to various countries as a starting point of negotiation with other countries. While these models are not legally binding, they have been extensively used by various countries as a reference point into while entering into tax treaties. In some cases, there may be an incorporation verbatim or with minor changes. However, such changes countries have been suitable changes in the draft model according to their economic environment and economical commercial tax consideration. A significant model conveyed in the had been briefly discussed under OECD model and UN model. OECD model. The emergence presence of the OECD model convention is a track based to the 1927 when the official committee and the League of Nations prepared the first draft of model from applicable to all countries. Section 149, 1946, the model convention was published in the Geneva by the official committee in UN of social, economic, culture, economical council. The later the organization of European Economic Cooperation, OECD, 1963. However, 1961, the Organization of Economic Cooperation and Development (OECD) was developed. These developing countries of its members to succeed the OEEC to OECD approved the draft presented in OEEC. 1987 final draft was prepared and presented form which has been revised several times, the latest being 2017. OECD model convention is essential model treaty between two developed nations. The model advocates a residence-based taxation. It lays emphasis on the right to state of residence of tax their income. UN model. In 1968, the United Nations set up an ad hoc groups of experts from various developed and developing countries. They proposed a draft model convention between the developed and developing countries. 1980, the group finalized the UN model convention in the present form. Since the first published in 1980, the model has been updated previously in 2001, 2011, 2013, and latest updated in 2021. UNMC is an UNMC model, United Nations model convention, compromise between the source of principle and residence principle. However, it would give more weight to the source principle against residence principle OECD MC model. The UNMC is designed to encourage flow of investments from the development of countries to developing countries. It takes into account of sharing tax revenue with the country providing capital. The United Nations MC seeks a balanced approach. It's a collaborative of the principle of taxation source, the accordance of the convention based on the recognition source of income tax. Taxation of an income was from foreign capital should take into account expenses, allocation of earnings, and income. So such an income is taxed in the explained basis. Taxation should be so high to discourage investment. In the taxation of income from foreign capital should be taken into account expenses allocated to the earning of this income so that it would be income is taxed in on net basis. The taxation should be so high so that discourage investment. It should not be too high. It should take into account of appropriation of sharing revenue with the countries and providing the capital. In addition, United Nations MC embodies the idea that it would be appropriate to residents countries to extend the measure of relief for double taxation through either the foreign tax credit or exemption, which is in the case of OECD model convention. US model. The model convention is used by the United States while entering the tax treaties of various countries. The US model convention is the last revised in 2016. The model have significant influence on intermediate trade tax treaty practice. Have important common provision. The similarity between the model highlights area of consistency. The area of divergence indicates some crucial difference of approach of emphasis that needs special focus. These differences are mainly in relation to the taxing rights, which should be available to the country, which domestic laws and extended to which a country should forego under the bilateral tax treaties in order to avoid the double taxation and encourage investment. The above model convention has been illustrated in the following diagram. Model convention: OECD model, UN model, US model. OECD model: the model convention between developed countries advocates residence principle. UN model: model convention between developed and developing countries, more emphasis on source principle. US model: applied in the United States. The OECD model chapter 7 charges comprises of 32 articles and UN models comprise 7 art chapters which comprise of 31 articles. List of the articles of OECD, MC and UNC model. Article OECD model 71 UN model 2021 chapter on source of scope of convection person covered and tax covered UN model taxes covered. Definition, Article 3 general definition, Article 3 general definition in use. Resident, permanent establishment, permanent. Article 3 taxation of income from income from income property. Article 7 business profit. Article 8 international shipping and air transportation and the alternative of A and B, international shipping and air transportation, alternative A and B. Associate Article 9 associate enterprises, Article 9 associate enterprises, and dividend 11 interest 12 royalties, 12A doesn't have fees for technical service, 12B free including income from automated digital services, 3 capital gains, 14 independent person services, 14 income from employment dependent person services, income from employment dependent person services. Sees director fees and remuneration of top level management function. As Article 70 entertainers and sportsmanship, artistry and sportsmen, 18 pension and social security payment, 19 government services, 20 students, 21 other income. Chapter 6 Taxation of Capital. Capital. A method of elimination of double taxation. 23A Exemption method. 23B Credit method and credit method. Special provision. 24 Non-discrimination. 25 Mutual agreement procedure. Alternate A and B. 26 Exchange information. 27 Assistance of collection of taxes. 20 Members of diplomatic missions and consular posts. Members of domestic diplomatic missions and consular posts. Article 29 entitled to benefits. Article 30 territorial extension. There is no territorial extension. Chapter 7 final provision. Article 31-32 enter into force. Article 32-31 termination. Let us discuss the comparative analysis of some of the significant articles in Model Tax Convention. A comparative analysis of some of the significant articles in OECD and UN Model Convention. Title and preamble of UN Model. Title and UN Model Convention reads the convention between A state and A species is elimination of double taxation, the respect of tax on the income and capital, and preservation of tax avoidance and evasion. That is specific reference to prevention of tax avoidance and evasion. It is a title of emphasizes its significance in UN Model Convention. The preamble of the UN Model Convention is read as about State A and State B. Desiring the further development of economic relationship and enhancing the cooperation of tax matters. The intending the concluding of convention of elimination of double taxation, respect of taxes or income on capital without creating opportunities of non-taxation or reducing taxation through tax avoidance or evasion, including tax shopping arrangements aimed to obtaining a relief, providing the convention of the direct benefit of residents of third states. Title and preamble of OECD Model Convention is almost identical to the UN Model Convention. There's only minor differences in reference to tax evasion and avoidance in the place of tax avoidance and evasion. Title and preamble. The preamble clearly indicates that UN OECD Model Convention do not intend to create opportunity for non-taxation or reduce taxation through tax avoidance or evasion, including through treaty shopping arrangement. This language of preamble would help ensure the provision of convention are interpreted and applied, prevented abusive treaty shopping arrangement. Significant articles of Model Convention. Over the years, both Model Convention have seen told converge. The language is identical in quite few articles. However, there are key differences in approach and language in some articles, while with the focus of discussion and section below. The jurisdiction or country of residence of taxpayer is deferred on the resident states, and jurisdiction of country where the source of income is located is deferred to source state. Article 1 person covered. The OECD and UN model should be applied in the person who are resident of one or more of the contracting state. For purpose of the convention, income derived by or through an entity, or arrangement and is treated wholly or partially facial transparency under the tax law, either contracting state shall be considered to be income of a resident of contract state. However, the same should be treated as an income only in the extent of the income treaty. for the purpose of taxation by the state as the income of resident of state. Example, state A, state B having include tax treaty identical to model tax convention. State A consider that the entity established by state B is a company. In the state B is a company. The taxation taxes the entity is an interest that it's received from the debtors resident of state A. This domestic law of state B, whereas the entity is treated as a partnership, and the two members of the entity who is equally asset income and each taxes acts on the half of this interest. One of the members resident of B and other is one of the resident of the country A and B do not have the treaty. The paragraph provide the case half of the interest be consideration in the for the purpose Article 11 to be income of the resident of Part B. The above example forms a part of commentary on UN Model Tax Convention. With the exemption of the benefit granted under the article on the convention, these convention would not affect the taxation of the contracting state of the resident. The article of UN Model Convention covers a provision dealing with the application of convention of collective investment vehicles. These funds of the widely held over the diversified portfolio of securities and subject to investor protection regulation in the country in which they are established. Reference to collective investment vehicles, CIVs like REITs. These funds adopt different legal structures and they may be set up by, for instance, a company's partnership, trust, contracts, agreements, creates a joint ownership. It is ensured that the investing through the domestic CIV would result in tax burden that is equal to the one of the applies in the case of direct investment. That is investment where CIV would not exist, or more the investor the CIV would have acquired directly in the shares of the asset held by the CIV. Article 2 Tax covers. The OECD UN Convention would apply to taxes on income and capital imposed on behalf of the constructing state or the political subdivision of a local authority, irrespective of the manner of which they are levied. Taxes on incomes and capital covers over taxes imposed on the total income, or total capital, or the element of income of the capital, including taxes on gains from the alienation of movable and immovable property, taxes on total amount of wages and salaries paid by the enterprises, as well as taxes on capital appreciation. The existing taxes in which convention would apply in the case which contracting states are specified to be mentioned. The convention shall apply also be identical to substantial similar taxes which is imposed after the date of signature of convention in addition to or a piece of existing taxes. The competent authority of the contract state shall notify each other of significant changes made in the tax laws. Tax residence. The taxpayer should demonstrate that he is a resident and one or more of the contract state is able to gain access to the tax treaties and avail the benefits thereon. The concept of residenting in the contract state has various functions and assuming significance in the following three scenarios. In determination conviction scope of application, solving cases where the double taxation arising as a compensation of double residence, and solving cases where the double taxation arising in the consequence of taxation in a state of residence, also a state of source of income. As of the paragraph on UN Model Convention term, residents of contracting states mean a person who, under that law of the state, liable to tax therein by a reason of that a person, domicile, a residence, place of incorporation, place of management, other criticism of similar nature also include the state and political separation of local authority, therefore, well recognized pension fund of state. This term, however, does not include any person who is liable to tax in the state respect of only the income of source of the state and capital situation therein. The paragraph 1 OECD Model Convention bordered on the specific lines. However, it does not contain a reference to the place of incorporation, does not include recognition pension fund. Where a person or a provision in the paragraph 1 individual resident of both contracting state that a status shall be determined follow. He shall be deemed to be a resident only of the state in which he is a permanent home available unto him. If he has a permanent home available to him in both state, he shall be deemed to be resident only in the state in which a personal or economic relations are closer, a center of vital interest. If the states in which he has a center of vital interest cannot be determined, as if he has not permanent home available to him in either state, he shall be deemed to be resident only of the state in which he has an habitual adobe. If he has an habitual adobe in both states in either of them, he shall be deemed to be resident only of the state in which he is in a national. If he is a national of both states in either of them, the competent authorities of the contracting state shall settle the questions of mutual agreement. As a paragraph 3 of article where a person for a reason of a provision of paragraph on a person other than an individual is a resident of both contracting state, the competent authority of the contracting state shall endure to determine a mutual agreement. The contracting state of which such person shall be deemed to be a resident for the purpose of the convention. They shall do not have regard to the place of effective management, the place where the incorporation otherwise constitute or any other relevant factors. In the absence of such mutual agreement, such person shall not be entitled to any relief or exemption of tax provision of the convention, except to the extent in the manner as may be agreed upon the competent authority of contracting state. The situation of dual residence may arise in the case of companies. In the case of one contracting state attaches importance to the place of incorporation, other state and the place of effective management. The tiebreaker rule traditional has been placed in the effective management. Even India has been place of effective management some of the cities. The latest update of OECD and UN hasn't changed a case of a case by case approach, considering the number of tax avoidance cases, including dual resident companies. Determination under the case approach will record to be an concerned taxpayer through the Article 25 mutual agreement procedure. The competent authority will then rely on the range of factors to resolve the questions of dual residency. The latest sentence of the paragraph 3 of article provides that in the absence of determination of the competent authority, the dual resident person would not be entitled to any relief or exemption from the tax provision of his conviction setup to the extent in which manner may be agreed upon the competent authorities of contracting state. And this will not, however, prevent the taxpayer from being considered as a resident of each contracting state from for proceeding other than granting treaties, reliefs, and exemption of this deposit. Article 5 Permit Establishment. The concept of permit establishment be defined by Article 5 as consider importance of business profit. Article 7 an enterprise cannot be taxed by a source of state unless provided by the existence of PE. The comparable term of PE under this Indian tax law is business connections. Article 9 1 General speaking, the concept of business connections is provided by the PE. Hence, the business connection may exist without the permanent establishment, but the absence of business connection may indicate absence of PE. As the PE indicates, as the PE indicate the source stage of its right to tax, it is an important article to developing countries. Hence, the UN model varies from the OECD model convention in the respective following respective. As per the Article 5.3a, the OECD model convention, the building site or a construction or an installation project constitute a private establishment. It lasts more than 12 months. The UN Model Convention is wider and is covered assembly or installation project or supervision activities in connection, therefore, to require the activities in question to continue only for 6 months or continuation of permanent establishment. Article 5.3b of UN model makes a specific reference to specific PE which is absence of OECD model. Article 5.3b in UN model reads follow. Furnishing the services including consultancy services, enterprise through employees or person engagement in the enterprise of such a purpose, but only through the activities of nature continue with the contracting state of period exceeding aggregate of 183 days or 12 months from the commencing of ending of financial year. In the absence of the service of permanent establishment OECD model, presence has been ascertained through general principle of Article 5.1. Article 5 states that base rule of the PE express the primary meaning of PE. The definition of PE is Article 5 does not use the qualifying records unless the context otherwise required as such that the definition need to be followed as the case may be specific in conclusion. Paraphrasing Article 5.1 PE exists the following condition of satisfying cumulative. There is an enterprise. Such enterprise is carrying out a business. And there is a place of business. Such place of business is a disposal of the enterprise as may be owned or rental and by but must be one of the enterprise having effective power to use. Place of business is fixed and it is established on distinct places and certain degree of permissions. The business of enterprise is carried out wholly or partially through a fixed place of business. A permanent establishment does not exist unless all the aforesaid conditions are satisfied. In Article 52, permanent establishment includes a place of management, a branch, a office, a factory, a workshop, a mine, a oil or gas well, or quarry, or any other place of extracting of natural resources. Agency of permanent establishment under OECD and UN model targets activities done by the dependent agencies of the enterprises in the country or source of state. Definition of the dependence against a permanent establishment includes instance when the agent habitually conclude contracts. Habitual plays a principal role, heading to a conclusion of contracts routinely concluded without material modification of the enterprises. Even more conventional P is constituted even if the person does not habitually conclude contract or not plays principal role, leading to the conclusion of each contract, but the habit maintained by the state, stock goods and merchandise from which the person regularly deliver goods and merchandise on behalf of the enterprises. The Udal model construction has additional articles 5, 6 relating to the insurance, which is the absence of OECD model. As per the article, the insurance enterprises or contracting state expect on the regard to the reinsurance deemed to be permanent establishment of other contracting states. If it collects premium in the territory of the other state and insurer risk situated therein 12%. Then this the absence of the similar article OECD model, P is insurance enterprises has defined according to the provision of Article 5 to OECD model. Article 7 Business Profits. The business profits of enterprise can only be taxed on a resident state. The right of source of state and tax business profit of enterprise only exists in the PE, exists in the deduction. As per the approach of OECD model convention, only the PE source of state of any tax or such profit has been attributed to PE. UN model convention amplifies the attribute of some attributes of principal limited force of attraction rule. The FOA rule implies that when a foreign enterprise sets up a PE in a state, of course, it brings itself official jurisdiction of the state. Such a degree of profit that is enterprise derived from the state of source, whether through the PE or not, can be taxed by state source. The Article 17 of UN Model Convention, if the enterprise carry out a business in other contracting state through the permanent establishment, the profit of the establishment can be taxed in other state, but only so much of the attributed to than the permanent establishment. Still, in that other state, goods are merchandise on the same or similar kind as to sold through the permanent establishment. Other business activities carried out in the other state and the same or similar kind of those affect of E. Article 11 Interest. In the paragraph, the article provides the right to resident states and tax employees. Paragraph 2. However, no such right to the source of taxed interest. Generally, the interest tax in the source state is given the rate of given basis. However, if the beneficial owner of the interest is a resident of other contract state, a tax cannot exceed a specific percentage of gross amount of interest. The OECD amount specified percent is 10%, but the UN model leaves a percentage to establish this bilateral negotiation. It may be noted that definition of interest in both the model OECD and UN model is similar in that its essential means income from debit claims of each kind. However, it's not secured by mortgage whether or not carrying a right of participate in the debenture profit. And as a particular, so income from government securities and income from the bonds and debentures, including premium prices attracted to such securities, bonds, and debentures. Penalty charges of the stake payment is not regarded as an interest for the purpose of the article. Article 9 Royalties. The article provides a right to contracting state to in total tax income or royalty. The key difference between the two model bases. As per the OECD model, the royalties arise from the source countries and beneficial owned by the residents or resident state, taxable only in the resident state. However, the UN model provides that royalty may be taxed in resident state. Hence, the UN model depends on the principle of exclusive right to tax provided resident states and OECD model. This is under the UN model. Source of tax may also be tax royalty. However, if the beneficial owner is a resident of a resident state, the tax charged at source state cannot exceed the specific percentage of the gross amount of royalties. This specific percentage is also established through the bilateral negotiation. The term royalty, as per the UN Model Convention, means a payment of any kind received as a consideration for the use or of the right to use any copyright of literary, artistic, scientific, including cinematic films, tapes used in the radio or television broadcasting, or any patent treatment, a design and model, plan, select secret formula or process, or for the use of or the right to use of industrial, commercial, scientific equipment, or for the information concerning industry, commercial, and scientific expenditure. The definition of royalty under OECD model does not include the following: rentals of film tapes used in the radio, television broadcasting, the equipments or rentals of rental industry, commercial, and scientific equipments. Article 12, fees of technical services. Now, India is a pioneer of FTS concept is added to income tax in 1961, 1996. Some of the tax treaties do not contain specific FTS. The UN are free for technical services. The UN model has a specific article pertaining to fees of technical services. There is no specific reference to FTS for fees of technical services in OECD model. The paragraph 1 and paragraph 2 of Article 12 provides that the FTS may be taxed in the resident states but does not provide the FTS exclusive taxable in the for residential states. Paragraph establish a right to country to FTS arising the tax accordance with the domestic law. Subject to the limitation of minimum rate of tax and gross amount of fees, it is a beneficial owner, resident of other contract state, and the minimum rate of taxes to be established through bilateral negotiation. FTS is defined as a payment of management, the technical consultancy service, but excluding payments to employees, payment to teachings in education institution or teaching by way of education institution, payment by individual by services for personal use. The management involving application of knowledge, skills, and expertise in the control, administration of conduct, and commercial enterprise of organization. Payment made to the consultant for advice relevant to the management of enterprise or for the business of enterprises would be FTS. Technical involves application of specialized knowledge, skills, and expertise with respect to particular art, science, profession, and occupation. The fees received by service provided by the regulated professions such as law, accounting, architecture, medicine, engineering, such constitute FTS. The services performed by other professions such as pharmacists, scientists, etc. may be constitute technical service. It is a service involves provision of specialized knowledge, specialized skills, and expertise. This in ordinary course is a consultancy involves provision of advice of services of specialized nature. For example, FTS can be seen in the following facts. Our company is a financial institution resident in our state. Our company provides a wide variety of financial service to the consumer, including accepting deposit, extension of credit, guarantees, foreign exchanges, negotiation instrument. Our company is in conducting primarily to our state, but also has clients in other countries, including status. And our state and status has then the tax treaty, which contains articles of Article 12. Payment received for service provided by a financial institution would be considered for FTS. And this services involve use of knowledge, skills, expertise, provides research, analysis, advices to service client, specific client related to particular components. This has been distinguished from the provision of non-specialized services such as payment and transmission of services, debits and credits and card, etc., which do not involve application of all specialized knowledge, skills, and expertise on behalf of the particular client. Article 12b Income from automated digital services. With the advent of modern means of telecommunication, as a spread of digitalization, aspect of digitalization, enterprises has ability to effectively engage in substantial business activities in the market country source tradition without the fixed place of business there, and to consolidate income from the digital automation of digital automation or digital service, and conclude contracting remotely, which technological means no involvement of individual employees or dependent agencies. Article 12b has stated that the Union United Model Tax Convention 2001 updated the preserve the domestic tax treaties and the state which payments of an automated digital services are made. There is no article of OECD comparison Article 12. The paragraph 1 Article 29b provides that the income from automated digital services or digital services arising in a contracting state. This underlying payment to which the resident another contracting state may be taxed in the resident state. It does not, however, provide the income from the automated digital service is exclusive taxable in the resident state. To establish a right to the country in which income from automated digital services arises to the tax in accordance with the domestic law. However, if the beneficial owner of the income is a resident of the resident state, the tax charged by the source state cannot be exceed the specific percentage of the gross amount of payment underlying the income from automated specific digital services. This specified article to be established through bilateral negotiation. Automated signal digital services. In definition, defined in the paragraph 5 means any services provided on the internet or another electronic network. Either case requires a minimal human involvement from service provider. An important indicator the concept of automated service where there is a liability to scale up and provide the same type of service to a new user with a minimal human involvement. Once the service was offered an automated digital service business develop such a music catalog or social media platform, then the business can provide the service to one user or more or many more on automated basis with the same basis of business process. On the other hand, a non-automated business digital services a business could be used proportionate increase the cost per unit in a connection with the providing service to new customers. The paragraph 6 the list examples of servers that may be constitute automated digital service. However, the provision of non-standing required the Article 5 should also be met. The paragraph should simply provides and indicates that activity may constitute automated digital services. It does not provide the activity listed therein necessarily to automate digital services. Following activities to explicitly mention in paragraph 6. Online advertisement services, supply of data, online search engines, online intermediate platform service, social media platforms, digital content service, and online gaming. Cloud computer service, standardized online teaching service. These categories are not mutually exclusive. For example, digital content service would be funded in whole or part of the online advertisement. Paragraph 7 provides that provision of Article 12b shall not be applied if the payment underlying income from automated digital payments qualify royalty or a fees of technical service of Article 12 or Article 12a. Capital gains. This is the most commonly used articles and provide a taxation of income arising from the transfer of capital asset, including transfer of shares. Right of tax income from its capital assets may be exclusive for residential state, shared between residents and source of states. The article does not specify that the capital gain how is computed and being left in applicable domestic law. The article contains rules and taxation of gains may be the alignment of different assets as immovable property forming part of PE ships and articles. The respect of the shares from the models are identical. The rights are conferred on the source state if more than 50% of the value of shares during the person is 365 days are derived directly or indirectly from the immovable property. Such a sourcing state, however, the resident states would be exclusive right to tax. Given model convention allow the state to tax gain from alignment of right granted under the law of the state along with the rights along with the uses of resources that is naturally present in the state and that is under the jurisdiction of the state. This however covers for example the alignment of rights such fishing quotas granted by the state, the right of fell timbers in the forest, the right to extract water, right to explore part of territory of state oil, gas, mineral, right to install wind terminal tidal steam engines, a part of territory of the state as well as a right to use all the part of radio frequency spectrum of the state, including cell phones and purpose. The provision does not cover the right to grant a contract between the private parties, even this right to protect under the state of law. This is alignment of exclusive right to know how each given state would be covered by provision of the act granted by the owner or know how is granted under the state of law. Both the UN OECD model convention gives exclusive right to resident state in the case of gains from the alignment of the property under that covered in other paragraphs of the article. Article 14 Independent Personal Services. Article 40 any person in the UN model is deleted from the OECD model on the basis of OECD report. The issue related to the Article 14 of OECD model convention. The effective of the deletion of the Article 14 is the income derived from the professional services now dealt with the business profit of OECD model. The articles deal with the taxation of income derived from a person or a proportion or specified services which is offered a source of the state through some presence. The article is independent personal services in the UN model reads under the income derived from the residence of the contractual state in the presence of professional services or other activities of the independent character shall be taxable only in the state except in some consideration when the incomes may be also be taxed in other contract state if he has a fixed place ways regularly available to him in a contracting state for the purpose of performing this activity as the case only as much of this income of attributable to the fixed base may be taxed in that other contracting state. If the stay or other contracting stay is for a period or a period amounting to or exceeding the aggregate of 183 days in any 12 months period commencing or ending to the final year concept, in this case only so much of the income as derived from the activity performed in the other state may be taxed in the other state. In terms of professional services, including especially independent scientifically, literary, artificial education, technical service, education service, as well as independent activities of physicians, lawyers, engineers, articles, and dental accounting. Thus, the article covers independent activities involving professional skills, rendering individual on principal to principal basis, meaning term professional service illustrated by some example of typical liberal profession. The enumeration has explained its character, only it is not exhausted. In excluding the industrial and commercial activities that is covered under the articles of business profit. Likewise, it also can exclude the professional service while the employment which is covered in the articles of dependent personal services. That is physician serving as a medical officer of a factory income artisan athletes in sports it's not covered in the article. Also income from fees and technical services it's also not covered. Article 21 Other income. The article deals with the taxation of items of income which is not specific taxation under the specific article. Key differences under OECD approach envisages this exclusive right to tax on the residential tax. The UN model contains an additional paragraph, Article 21.3, which provides an source state which may also tax under the income. Article 21.2 both OECD and UN model provides that the income effectively connected with the PE maintaining the contractual state of the resident and other contracting state. Taxation is governed by the provision of Article 7 business provision. Addition to the UN model provide that it is an aforesaid income in effective connected with a fixed place situated in the contracting state by a resident in other contracting state. Taxation will be governed by the provision of the Article 14 independent personal services. Article 23A, 23B eliminating double taxation. In the cases, the application of the tax authorities may result in double taxation to taxpayers. In such cases, in order to provide a relief to such taxpayers, Article 13B or 13B which contains provision relating to elimination of double taxation to be qualified. Um, the OECD and UN OECD in conjunction two approaches exemption method or credit method 23 23 and 23. Under this exemption method, a taxation exemption may be available in the residential state. Under the credit method, tax credit can be available in the residential state or the tax deducted in the source state. This method is not mutually exclusive, and there may be cases where the treaty may adopt exemption method for certain incomes of income and credit methods on other incomes. Double taxation refer to the jurisdictional double taxation, meaning some incomes or capital is taxed in the hands of same person by more than one state. It does not thus encompass situation of economic double taxation. That is, two different persons are taxed in the respect of the same income or capital. If two states wise to solve the problem of economic double taxation, they must do so in bilateral negotiation. Article 15 Mutual Agreement Procedure. There may be a situation wherein taxpayers may really believe that taxed accordant by either on the both contractual state or not according to the provision of tax duties. In such a case, there is a need of adequate resolution which is addressing by the articles. These articles require compute authority for both countries to endure to resolve the conflict by engaging the bilateral negotiation. The UN model convention based two alternative, alternative A, alternative E for the Articles of Mutual Agreement Procedure, which is introduced in 2011. The OECD model of the taxpayer may have requested either contractual state or UN model alternative E. Contemplates taxpayers going to residential states of the country of nationality. Alternative B of UN model Article 25 constitutes reference to the arbitrage process by method of mutual agreement procedure. The decision arrives at through the process of binding unless a person directly affected does not have accepted. The key difference between OECD model convention and UN model convention, that is Article 25 and Article 25B alternative as follows. Article 25B 25 part class 5, the UN model provides arbitration may be initiation if the competent authorities are unable to reach the agreement on the case within 3 years from the presentation of the case. However, Article 25 OECD model provide time limit for 2 years from the date of all the information required by the competent authorities in order to address such case need to be provided to both competent authorities. Article 25b5 UN model provides arbitration must be present requested by the competent authority of one of the contracting state. One such request is made, the taxpayers must be notified. However, Article 25.5 of the OECD model, arbitration must be requested in writing by the person who is initiating a case. Article 25b5 UN model allows the competent authorities to depart from the arbitration decision if they agree to do so within 6 months from the decision has been communicated to them. Article 26 Economic information. In order to complete tax cases, the court may require certain information which may be available with the treaty partner. Article 26 provides an information which may be exchanged and the manner in which this request has been made. Purpose of Article 26 and facilitate effective exchange information in contracting state. From the perspective manner of developing countries, Article 26 provides important not only to curtailing cross-border tax evasion but also curtail the capital fight that is after accumulated through such evasion avoidance. The OECD and UN model conviction is similar with respect to the article. The contracting state cannot be expected to more confidential financial information to another contracting state unless the confidential information will not be disclosed to unauthorized person. The contracting state may avoid exchange of information obligation to show that the information pertains to the communication between the attorney and the client is protected for the disclosure under domestic law. However, the lack of interest or use of the information cannot be basis of contracting state or to non-cooperate with exchange information. So the disclosure of a model tax convention of the above chapter is essential based on the text and commentaries of OECD model convention 2017, new model tax convention 2021 available on the website and respectively. Summary. Article OECD MC versus United Nations Mutual Consent, common paras and significant differences. Chapter 1 Scope of the Convention, person covered, residents of CS, the contracting states. For applicable treaty, a person has to be resident in one or both of the contracting states. Fiscally transparent entity. The income derived by or through a fiscally transparent entity under the tax laws are either contracting state to be considered to be income of the resident or to the extent of the income is treated for the purpose of taxation by the state as the income of the resident or the state. Collection investment in a vehicle. The provides deals with the application of UN model convention to collection investment vehicle. Tax coverage. Taxes on incomes and capital. The MC companies. MCs applies mutual consent contracting states, mutual seats applies to the taxes on the incomes and capital imposed on behalf of the contracting states of the contracting stage of the politically subdivided or locally authorized, irrespective of the manner in which they are lived. Coverage of taxes on the incomes and or capital covered, taxes imposed and taxes employed. Taxes imposed included on the total income, on the total capital, on the element of income or capital, taxes on the gain from alignment of movable income or property, taxes on total amount of wages, salaries paid by the enterprises, taxes on capital appreciation. Chapter 2 definitions. Residents of the contracting state. Either resident of either contracting state. The taxpayer has to demonstrate that he is a resident of one or both of the contracting state to be able to gain access to the tax treaty and avail benefits thereunder. Meaning of the residents of contracting state. A person who under the law of the state is liable to tax therein for the reason of such person. Domicile, residence, any other similar creation, place of management, place of incorporation. Terms therein does not include any person who is taxable liable to tax in the state in respect to only of the income from the sources in the state or capital situation therein. Now, OECD MC does not contain refers to place of incorporation. Tiebreaker rule. In case of individual, where the individual is a resident of both contracting state, as per the domestic tax laws of the contracting state, then the resident status will be determined by applying the tiebreaker rule in the following sequences. permanent home, center of vital activities, habitual mode, nationality, mutual agreement between the contracting states of the contracting state. In the case of companies, dual residence arises from the contracting state attaching importance of person of interest under the POE, permanent of instrument, and the other contracting state of POEM. Tiebreaker test involves case approach. Consider the number of taxes avoidance cases involve dual residence cost companies. Request to be made by the taxpayers through the Article 25, and the competent authority may rely on the range of factors to resolve the questions of dual residency. Article 5 Permanent Establishment PE. Meaning of permanent establishment PE. There should be enterprises, and the enterprises should be carrying on a business. There should be a place of business. Such a place of business should be treated for disposal of an enterprise by maybe a owner, owned or rented, but be one of the enterprises has a effective power to use. The place of business should be fixed. It must be established in distinct place in certain degree of performance. The business of enterprise is carried out wholly or partially through the fixed place of business. The permanent establishment does not exist unless all these aforesaid conditions are satisfied. Specific inclusion for the meaning of PE Article 5.2. A permanent establishment is a branch, a place, permanent establishment, place of management, permanent establishment is an office, permanent establishment is a factory, permanent establishment is a workshop, permanent establishment is a mine or oil, gas well or a quarry. Expansion of scope of agency, permanent establishment. Agency in a permanent establishment target activities to be done by the dependent agent of the enterprises in the source state. The DAPE now includes instances when the agent habitually plays a principal role leading to the conclusion of contracts routinely concluded without material modification of the enterprises. The UN Model Convention, the PE is in conclusion even if the person does not habitually conclude the contracting nor plays a principal role leading to the conclusion of the contracting but habitually maintain the state. The stock of the goods and merchandise from which the person regularly deliver the goods or merchandise on the behalf of the enterprise. The P of an insurance enterprises. UNMC and OECD-MC. UNMC has additional Article 5.6 relation to the insurance. Insurance enterprises or the company secretaries deemed to have PE other company secretary if they collect the premium in the territory other contracting state ensure risk divided therein through the person. OECD model. The absence of the similar articles in the OECD MC model, the permanent establishment insurance enterprise to be determined according to Article 5 and 5.2. Chapter 3 Taxation of Income Business Profile Right of Contracting State or Tax Business Profit Business PP OECD and MC model. The business profits of the enterprise can only be taxed by the resident state. The right of the source state to tax the business profit of the enterprise only exists on the permanent established exists in the jurisdiction. Once a PE is proven that SSS can tax only such profit as the attributable to profitable to the business profits. Permanent establishment. UN model. The attribute of principle is amplified by limited force of attraction rule FOA. Therefore, for force of attraction rule it implies that when the foreign enterprises set up and PE in the SS, it brings itself within the facial jurisdiction of the state in which degree of the profit the enterprise derives therefrom. Whether they're through the PE or not can be taxed under the SS. According to the enterprises carried on the business of other company secretary, the profit of the enterprise can be taxed in other company secretary but also made by them as attribute. The permanent establishment sale of the contracting company secretary goods or merchandise of the same or some similar kind as the sold through permanent establishment. Other business activities carried on in other state of the same or similar kind as affected through P. Interest right to company secretary tax of interest. Para Article 1 right to company secretary contracting state to tax interest. Conform to right to residential status of the tax interest. Para 2 confer the right to assess to tax interest. Therefore, the interest tax on the source at the given rate of cost basis. However, the beneficial owner's interest in the residential of the company the tax so charged should be less than the specific percentage of gross percentage. The percentage of OECD model is 10%, but the UN model leaves a percentage established through bilateral negotiation. Definition of interest on OECD and UN model. Interest must means income from the debt services of any other kind, whether or not secured by the mortgage and whether or not carrying right to participate in debt that has profit. Specific inclusion, the definition of the interest per OECD UN model. Income from the government securities, income from bonds and debentures, a premium and prices attracts to such securities, bonds and debentures. Interest does not include penalty charged by late payments. Article 12 royalties. OECD, MCN, UN model. Right to company secretary to tax royalty income. A ROI arises the SS and beneficial owner by residents of the RS and taxable only in RS. This RS is an exclusive right to tax royalty income. UNMC. The ROI may also tax in the SS. However, the beneficial owner of the residents of RS, residents RS. Tax charge in the SS should be less than the specified to be established by the bilateral condemnation of royalty. Definition of royalty. The definition of royalty does not include rental from films types used in radios and TV broadcasting, rental from industry commercial specific requirement. Royalty includes a rental of films and tax tapes for radios and TV broadcasting, equipment rental like rental of industries commercial specific, including UN model. Article 12 FTS. Under the UNMC has specified rule pertaining to the fees of technical services. There is no consideration, no specific reference to the fees of technical services in the OECD MC model. Right to SES of tax to FTS services free of technical service UN model. Para article 1 right to CS2 FTS refer to the right to the RS registering state or to the tax of right to fee of technical services. However, does not state that fee of technical service is exclusive taxable to residing state. To establish in the to establish a right of access to the tax of FTS accordance with the domestic law and subject to limitation of the tax and the rate of taxes on the gross amount of fees to be established through the bilateral negotiation in the bilateral beneficial owners as the residents of the US. Meaning of FTS fees of technical service UN model. The fee FTS fees of technical service means payment of a manager or technical consultation is obviously exclusion for the meaning is payment to an employment, payment to a teaching in or any other education institution, payment to an individual of a service of personal use. Article 12b income from automated service digital services. Article 12b is added to the United Nations Model Tax Convention in the 2021 updated by preserving domestic law taxation rights to the states in which payment of automated digital tax services are made. There are no such articles in the OECD MC respond to Article 12b. A right of CS to tax income from automated digital UN model. Para Article 1 2 right of CS to tax the income from automated digital services confers right to the resident state to tax income from automated digital services arising from the contracting state. However, does not state that the FTS is exclusive taxable in the resident state. Establishment the right of the SS to tax income from automated digital services in accordance with the domestic law, subject to a specific percentage of the gross amount of payment underlying the income of automated digital services to be established therein by bilateral negotiation. If the bilateral owner or the residents in the case. Meaning of automated digital services UN model. Automated digital service is any service provided or internet or another electrical network. In either cases require minimum human involvement in the case of service provider. Specific inclusion online advertisement services and the supply of user data. Online research engine, online intermediate platform service, social media platform, internet content services, online gaming, cloud computing service, standardized online teaching services. Article 13 Capital Gains. This article provides taxation of income arising from transfer of capital or asset and including transfer of shares. The right of contracting state to tax income on the capital gains. The right of tax capital gain may be exclusive to the residing state and shared between the residing state and SSR. The articles does not provide specify that the capital gain how to be computed being left to the applicable domestic law. The article contains the rules of taxation of gains of alienation and different assets on the immovable property. Immovable property they form a part of permanent establishment, ships in aircraft, etc. In respect of shares, OECD, UNMC's identical rights are conferred in the SS more than 50% value of shares and pertaining to the 365 days and derived article directly indirectly involved property. As however, the resident state should be exclusive to the tax. UNMC allows the tax to tax gains from the alienation of the right gained under the law of the state so long as the rights allows the use of resources that is naturally present in the states that are under the jurisdiction of the state. Both the UN OECD model convention gives exclusive right to resident states and claim cash gains from the alienation of any property other than the covered in the paragraph articles. Article 14 Independent Person Service. Any article presented only in the UNMC deals with taxation of income derived from a person for a professional specific service which is offered to assess through the some persons. Right of CS tax income from a professional services IPS UNMC. Right of RS income derived from a residence of CS respect of professional services other activities of independent characters and tax in RS. Right of SS the following circumstances however IRS IPS may also be taxed in other CS or SS. Circumvented extended to the income taxable. If he has a fixed base of regular available to him, the excess of the purpose of performing activities. Only so much of the income as per the attributable to the fixed base may be taxed in excess. If this stays in the excess in the period of greater than 183 days, 183 days in the 12 months, then the commencing of ending of fiscal year. Say it now as 12 months is the commencement of ending of each year. Only and an extent of income taxable basis. In the case of XP is regularly available to the masses for the purpose of performance activity. Only so much of the income that is attributable to the fixed base may be taxed in SS. If the stay in SS is more than 183 days in any of the 12 months period commencing of the ending of the fiscal year commences, only so much of the income is derived from the activities as may be taxed in the state. Attributable derived from the activities. So definition of professional service in UNMC. The term professional service includes especially independent scientific, literary, artistic, education, technical activities as well as independent activities like practitioner, lawyers, engineers, artisans, dentists, and accountants. And the OECD MC does not contain separate articles of IPS. This cell deals with the business profits under the OECD MC article. Article 21 Other income. The articles deal with the taxation of items income which is not specified taxation article. A right to taxation OECD MC model UN model. Exclusive right to tax with the residing state. However, that contains an additional para article 21.3 which states that SS may also be taxed in other income. Right to tax right to tax income other than the income from immovable property effectively connected to PE. Article 21.2 both OECD and UN model purposes that for the income derived connected to the PE established in CS by the resident of other CS, taxation is governed by the provision of Article 7 profit tax. In addition to the UN provision that if the aforesaid income is effectively connected with the fixed base division of US by the resident of other US CS, taxation would be governed by the provision of the Article 14. Methods of elimination of double taxation 23A, 23B exemption method. It may be noted the application of tax treaties may be a result of double taxation DD taxpayer in the case of Article 23A, 23B provided that